Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's an award-winning Wall Street analyst. He's also published a couple of books. His book in 2004 was The Coming Collapse of the Dollar and How to Profit from It, Make a Fortune by Investing in Gold and Other Hard Assets with James Turk, the founder of Gold Money and former investment banker. His most recent book, which I think is very appropriate now, came out about 10 years ago in 2014, The Money Bubble, What to Do Before It Pops. John Rubino, thank you for joining me again.
Hey, Jason, good to be back.
So, John, we're recording this interview on Wednesday, May 29th, 2024. The gold price in US dollars is correcting a little bit right now. I mean, it's gone up a lot since November and December. It went up at one point over $500 an ounce. It's a little bit above 2,300 at $2,336. I want to get your thoughts, though, on applying the money bubble that you wrote about 10 years ago to now. How much currency have governments and central banks, and it's not just the US government, but all of them, created since the pandemic started in 2020?
Oh, they've created a lot. But let me say about the money bubble before we start. With an investment book, timing is everything. You want the things you're predicting to be happening as the book comes out. The money bubble, 10 years later, the stuff James Turk and I predicted are just starting to happen now. So didn't quite get the timing right, but the specifics of what's going on fit very nicely with that book. So that makes it still timely. But anyhow, yeah, with the pandemic, we totally panicked around the world. And, you can argue about whether it was a literal panic or whether it was a contrived panic in order to funnel hundreds of billions of dollars into big pharma. And that's an arguable point, but the money supply numbers at least scream panic because we increased the US money supply by 40% to 60%, depending on which monetary aggregate you're using. And you can't do that without raising prices because basically if you increase the money supply by half, then that's a lot of new dollars chasing the same amount of stuff. And during the pandemic, we weren't even producing as much stuff as we had before because of all the lockdowns. So you got inflation, which the mainstream economists for the longest time had been saying, well, where's this inflation you keep talking about? Well, I don't think that's real. And finally it actually happened. And Paul Krugman and the rest had to admit that the whole, inflation isn't real. Oh, it's transitory. That was all wrong. When you increase the money supply by a dramatic amount, you increase the prices of things. And that's what we define in the mainstream as inflation. So we got that. And now the average American's cost of living is maybe 1/3 higher than it was in 2020. That's the source of a lot of the political turmoil we've got going on right now. A lot of people, it's funny, again, Paul Krugman, he's an easy guy to kick in this scenario because he's been wrong about everything. But he keeps publishing New York Times columns explaining how the ignorant masses don't understand how great the economy is. And that's why they're frustrated because they just don't know how good they've got it. And of course, what he doesn't know as a very well-paid urban intellectual, he doesn't know how hard life got for people who were just getting by in 2020 and then had their cost of living go up by a third. Now there's millions of people, tens of millions of people in the US who have to decide between paying the rent, putting gas in the car, and feeding their kids. And that's a recipe for a very unhappy electorate and very tumultuous elections. And that's what we've got going on right now. So we've got chaos in both the financial markets and in the political system brought about by the obvious mistakes that the world's governments have made in the last 3 or 4 or 5 years. And there's no real end to it now. I think we put ourselves in a box that we can't get out of, which is what, Jason, you and I and people like us have been talking about for such a long time. There would come a time when central banks were faced with two big problems. Their currency is losing value and their interest rates are going up. And you can't fix one of those things without blowing up the other, right? So that's where we are now. Japan is in probably worse shape than us, but we in the US are in very bad shape in those terms.
And so let me add to some points that you made here. We're now, since 2008, there's been a lot more debt added by corporations, although they did lock in lower interest rates, but the total amount of debt, I think, has doubled for US corporations. The government debt has just exploded, though, the last 15 years. I think, if I remember correctly, around 2008, there's only a little bit above 200 trillion global debt. And just in the last 15 years, another 100 trillion plus was added. So we're over 300 trillion in global debt now. The majority of that debt is not necessarily in the private sector. A lot of it's government debt and entitlements or bailouts. And at this point, like you said, the central bankers and the governments, their finance departments, finance ministries, they do not have good options. I would argue a lot of these central banks, not just the Federal Reserve Bank or the Bank of Japan, a lot of these central banks seem to be trapped. And a lot of it has to do with government debt, where the central banks can either let inflation run hot, so let the real inflation rate run above the yields on the government bonds, kind of like global yield curve control, Japanification. I believe something similar is being called fiscal dominance now.
Yeah, in the US, we raised interest rates to try to slow down inflation, but that would have crashed the economy. So the federal government started running massive deficits to protect us from the tight money collapse that we would have seen. And that's an example of being in that box where there are things we can't fix. Um, what's happening now with let's take Japan, the US, and Germany as three big examples because they're super important economies, and they're all kind of in the same place where they took on massive amounts of government debt. And then inflation started to pick up post-pandemic. And so now interest rates have had to go up to counter rising inflation, but that is spiking the interest costs of all these governments. So you're seeing for instance, the cost of US government debt in terms of interest is going straight up. It's going parabolic. And that money, we're up to like over $1 trillion a year now, and it's heading for 1.5 trillion in the not too distant future. That money has to be borrowed. So that increases the deficit, which increases the debt, which increases the interest costs on that debt in basically a death spiral. And Japan is in really worse shape than us because their government has borrowed even more per capita than the US government has. And Germany is right there with them, though. So we're seeing these big governments faced with a version of bankruptcy at some point. Although they claim, well, we just keep on creating currency, so we won't go bankrupt. But at a certain point, creating more currency in order to cover their massive deficits will crash their currencies. And that's where Japan is right now. They're seeing the yen fall and interest rates rise at the same time. So they can't use one single policy to address both of those things. They either have to raise interest rates to protect the yen, keep it from falling, because when a currency is falling, that's very inflationary, or that they have to let the yen fall and bring interest rates down because rising interest rates will bankrupt them. And those are their choices. So either
Well,
thing that they do.
they tried to do it temporary, right? So they tried to temporarily slow down the currency devaluing against the dollar, and they tried to sell some treasuries, 60 billion, but that only lasted for a day or two, and they wasted a lot. With $60 billion for a currency intervention for 24, 48 hours.
Yeah, running through their foreign exchange reserves will not save them because their interest costs are going up so dramatically, and the yen is falling pretty hard, at least against the U.S. dollar, and gold big time. Gold is spiking in yen terms. So there's nothing they can do that fixes both of their problems, and they have to choose one. See, that's what I'm talking about by a box that you can't get out of. You have to choose a major crisis because the other major crisis is probably worse. And it's not clear what they'll choose because, what do? Do you let your interest rates go up, bankrupt the government, and cause a depression? Or do you push interest rates down and let your currency just fall off the table, which will spike inflation, which will put you right back where you were, with soaring government debt? So it's not clear
Well,
what anybody's going to choose, but nothing is going to work for them.
Well, I would argue the Federal Reserve Bank is trapped now and doesn't have good options, and the options have just gotten worse because of the budget deficit spending that has kept increasing by both political parties in Congress or the White House. And it doesn't really matter which major political party is in control of either, because Democrats are tax and borrow and spend, and the Republicans want to do mostly supply side economics, which is also central planning. They don't really cut the size of government, it's borrow and spend. So the policies are very, very similar. It's all central planning. And here we are. The fiscal 2025 budget spending projections are projected for over $7 trillion of spending. And that's not even counting that high interest payment on the national debt of potentially, like you said, 1.5 trillion by the end of 2024. So that we're looking at like over $8 trillion of government spending. And a large chunk of that now is going to be just interest payments on the debt.
Yeah, yeah, we're basically beyond repair here. It's just a question of, like in the movie Ghostbusters, where they meet that alien god, and it says, "Choose the means of your destruction." And we're kind of there now. We just have to pick our thing, and let it blow up. But the way we got here, I think, is very interesting, because in 1971 we went off the last vestiges of a gold standard. The gold standard is basically a control on government spending and currency creation. You take that away, and all the big governments had unlimited credit cards. So we gave politicians and generals and corporate CEOs and appointed bureaucrats the ability to create money out of thin air. And of course, they totally blew it. They abused that privilege. And we have had rising debt levels ever since. And now we finally reached the point where we can keep going with this for a little while, but only at the cost of some gigantic crisis that we have to choose by, or that we have to bring about by choosing to fix one thing and let another thing run. And that's the death spiral. And it's going to end with the world's fiat currencies just collapsing in value. Or
So by choosing the options here about the debt spiral, do you mean like one of the options is bankruptcy? So letting some banks, corporations, small businesses fail, not giving out stimmy checks or whatever the pandemic loans. I forgot the name of the little government soup loan program for small businesses where there was tons of fraud and abuse. So not doing bailouts, like actually allowing deflation and bankruptcy, or what yield curve control, like hoping that most people don't notice that there's a lot of stagflation going on in the real economy.
Yeah, okay, that gives us a really good example here. Because let's say commercial real estate, which is teetering right now, let's say that starts blowing up. A lot of office buildings get sold at massive losses, and then the local and regional banks have to take those losses, and then everybody pulls out. All the depositors pull out of those banks, and the banks start to fail. So that we're at that point that you just specified. Now the government has to decide whether to step in and bail these guys out or let them collapse. So if they let them collapse, we get a 1930s style deflationary depression. That's one choice. If we step in and bail them out with several trillion more dollars on top of what we're doing now, we get rising inflation, which is the same thing as saying a plunging value of the currency. To a point where it spins out of control, where everybody starts front running it because we recognize that it's the government's policy now to inflate away the currency. So we get out ahead of it by dumping our currency to buy real things: gold, silver, farmland, oil, et cetera, et cetera. And those things spike in price, and that becomes a kind of a hyperinflation / currency collapse. So that's the choice. It's not like they have anything else that they can do except one of those two things. And I suspect they'll go the inflationary route, because that seems longer term from the point of view of the government. Like if you're looking at a deflationary crash that happens this year while it's on your watch, you're this generation's Herbert Hoover, and you don't want that. But if you generate 2% more inflation this year, so you get 12% instead of 10% inflation in the year ahead, you might be able to retire, leave office before it really hits the fan. And then you'll have part of your reputation intact for the rest of your life. So they will choose that every day, I think. And that's what they're doing right now. I mean, we tightened a little bit. We raised interest rates to historically normal levels, but the federal government stepped in with massive deficit spending because they could not allow those interest rates to actually bite. And the government deficits that we're running right now are in effect a bailout. of all the entities that would have gone bankrupt if the government was running a balanced budget right now, right? So we're choosing inflation. And there might be some bumps in the road. There might be some arguments at the very top about whether that's the right thing to choose. But I think in the end, the nature of the people who are in charge right now pretty much guarantees they'll choose inflation. Because remember, these are 50, 60, 70-year-old guys. For their entire adult lives, easy money was how you get out of trouble. You bail out everybody in sight, you create a lot of new currency, and then normalcy returns. So that is their wiring, always go for easy money in any kind of a pinch. So I'm reasonably sure they'll do that. So we're going to get another stretch like 2022, 2023, when inflation was scarily almost out of control. Only the next time around, it probably will be out of control. And that's the story of the coming decade, if not the coming 1 or 2 years.
Also, for about 40 years, there was a bond bull market and falling interest rates here in the United States for the most part. Now, there was some Fed rate hiking cycles, but it did blow things up, and the Fed had to step in with different levels of bailouts, and they just got orders of magnitude larger since the tech bubble. But in general, there was a bond bull market and falling interest rates, and it looks like that period with the bond bull market of the long-term interest rates, where a lot of these hedge fund managers or bank portfolio managers would use a ton of debt, say like Ken Griffin with the basis trade or Ray Dalio with risk parity. And so for a 60-40 modern portfolio, they take out the US Treasuries. And then for the 40% of the portfolio, that the bond portfolio manager at the bank, he'd leverage up the bond portfolio by enormously. And so risk parity was making lots and lots of money by juicing up the bond side of the returns. But in a rate hiking cycle, those trades blow up.
Yeah. Can you imagine for like 20 years there, how much money was made in leveraged bond portfolios? You borrow money at 3 or 4%, and you get a 6 or 7% treasury yield return plus capital gains when the price of the treasury bond goes up, and that was some seriously easy money made by a bunch of today billionaires, people who weren't billionaires when they started, but who made billions. And yeah, those days are over. Now the world is a much harder place to function in because the bias is down and not up in terms of wealth. In other words, most things are going to lose value going forward. There's just a handful of things that are going to do great in the next few years. And obviously, gold and silver are at the top of that list because that's what always does great when a country destroys its currency. You can go all the way back to the Roman Empire, and it's been the same story. The people who own gold and silver tend to get through whatever troubles there are in pretty good shape. And it doesn't matter if it's a revolution or a hyperinflation or whatever, natural disaster, gold and silver maintain their value. So we can assume that that's going to be the case again, especially since governments are clearly making the inflationary choice going forward.
Yeah, I
And
mean, look at the other currency exchange rates against the dollar. You brought up the Japanese yen. I mean, the gold price in Japanese yen, it's been going parabolic the last couple of years. It was flat for a long time. There was hardly any gold demand in Japan by the private sector. And now it looks like in the last 6 to 12 months, there's been a phase shift, a paradigm shift. I think there was a tax law change for retirement accounts in Japan. And now people with a large amount of capital in their retirement accounts in Japan think they can buy over $100,000 of physical gold tax free. I think there's like a maximum amount of physical gold that they can put in there tax free. So it's starting to create demand. And this gold bull market that looks like it's restarted in the last 6 to 9 months, especially here in the U.S. now with the U.S. dollar gold price rising compared to the other gold prices, which were already at or near an all-time high over the last 12 months. The demand drivers almost entirely for the private sector. It's in China, India, Japan, Korea, Vietnam, Thai pension funds, other parts of Asia. The Western investors really are not really into it yet.
yeah, well, I mean, this is just what gold does when inflation starts to pick up. It happened in the 1970s when gold went through the roof, and then it happened in the 2000s when between 2004 and 2011, more or less, gold went parabolic, and we're basically in the same kind of a situation. So yeah, this is what you should expect. And in that sense, it's not surprising at all. And if you look at the chart, like you said, the gold chart in Japan is parabolic. It's really rocking, and that's just why it's happening. And
Korea
so,
too, they're selling gold out of vending machines now. I mean, the gold price in Korean won is also soaring too.
you know what's really interesting is the arbitrage that's happening now. You can buy, well, silver is the last one that I looked at, but it's the same thing for gold. You can buy silver for $32 an ounce in New York or London. And the price of silver on the Shanghai Physical Metals Exchange in China is 36 or so dollars an ounce. So you got this arbitrage where you buy silver in London, send it to China, make, $4 an ounce on it, basically risk free because you're kind of doing simultaneous trades there. And that's sending a lot of both silver and gold from west to east as people take advantage of this arbitrage. And it also means that the physical is starting to trump the paper price of gold and silver. In other words, the actual metal is starting to be the benchmark that determines what the price of those things are, instead of the games that they're playing with futures contracts on the COMEX or whatever. And that's another thing we've been talking about for years. That someday physical is going to start dictating prices in precious metals, and boy, the price will be so much higher. Well, we're seeing that happen now. Gold is up dramatically, and physical is the reason for it. And that there doesn't seem to be any end to that process because there are an awful lot of people in China and India who really don't trust their government's currencies. And to the extent that they have cash, and also have a cultural tradition of giving gold and silver jewelry as wedding gifts. So there's kind of built-in demand there, and that's also due to historically not trusting the currencies of their governments. They give real wealth in the form of jewelry made out of gold and silver to brides and grooms as a way of starting them off in life with something that's going to hold its value over long periods of time. So, so yeah, it looks like physical demand doesn't have an obvious end to it right now in Asia. And it looks like that's now determining the pricing for gold and silver. So that's incredibly favorable for gold and silver. I mean, not to say there won't be corrections along the way, but this definitely looks like a bull market with legs. And it looks like one that's going to end with a parabolic move that dwarfs those of the past few cycles. So I would say strap in. Don't jump in with both feet into anything right now because there will be corrections along the way. But steadily add to your gold and silver. Of course, look at other real assets. Energy stocks, uranium stocks, copper stocks are all really interesting. And farmland, if you can get it, is absolutely the kind of thing you should be looking at now in this kind of an environment.
I think since November, the commodities index that tracks like a basket of commodities, I can't remember if it's overweighted for energy or metals, but it's up around 20%. So there's been a substantial rally across the board for a lot of different commodities. There's only a few commodities that are lagging, like platinum and palladium right now. So those are cheap and out of favor. Natural gas has rallied a little bit, but it's still down a lot over the last couple of years. So it was around like $2.50 in the last week or two, but that was up from I think $1.60 in the last month or two. So it did bottom out maybe in the last like 3 or 4 months and it started to rally a little bit. But those ones are out of favor as well. I think commodities historically, the asset class over long periods of inflation or stagflation, although the governments didn't call it stagflation back then, but that's the asset class that tends to be the best inflation hedge, better than stocks over longer periods of inflation.
Yeah, I think if we were going to rank the different commodities categories in terms of their business case for the coming decade. In other words, how well the companies will do in that space and how much the price of the commodity will probably rise over time. I would say uranium is first. That's just a phenomenal story from an energy supply standpoint. Then gold and silver, obviously, for reasons we talked about. Then copper because we're electrifying the world and we're going to need a lot more copper than today's mines produce. And the only way to get that is to have prices go up far enough to incent miners to look at less economic deposits, because that's basically almost all that's left out there now to be developed. And so prices have to go up if we're going to do what we intend to do with the energy system in the world. So all of those guys are just looking great. And then within the rest of the commodities complex, there are other things that are basically part of the same story. A lot of the energy metals out there have a similar story to coppers, right? Because we're going to need a lot of zinc, we're going to need a lot of nickel if we're going to have electric cars and nuclear power plants far from cities generating massive amounts of electricity, or modular nukes sitting everywhere that that use those metals one way or another.
Oh, you mean
So
smaller modular nuclear reactors? That's like the next
yeah,
generation. They're testing those now. They haven't been
yeah,
commercialized yet.
yeah. That's not a guarantee yet. And one of the big projects failed just lately, so we don't know for sure if it's going to work. But if it does, that is a huge boost for the nuclear power, or in other words, for the uranium miners, because we'll be able to put base load power pretty much anywhere in bite-sized pieces. It can run a small town, a modular nuclear reactor, or a neighborhood in a city, or something like that, or one office complex. Um, and we don't know for sure how that's going to work out, and how small the modular reactors are going to be able to be, and whether you can hook them together and make a really big, you know, quasi-nuclear, full-size nuclear reactor out of them. That's all still to be determined. So, but even if you leave that out, even if they don't work, the modular reactors, next generation full-size nuclear is probably going to be great. China has this huge um, backlog now, or pipeline of nuclear reactors that are going to go online in the next decade, and a lot of other countries that shut down or otherwise moved away from nuclear power are moving back. So I
Well, China
mean,
and India, let me add to your points there. China and India, you just have in general enormous electricity demand growth. I think India just set a record for electricity demand usage growth. They have factories moving from China, so India is one of the beneficiaries of factories that are leaving China. But China is still building, I think, one coal-fired power plant per week. I mean, it's probably clean coal compared to the coal-fired power plants of the past. From what I've heard, they're upgrading those. So China's investing across the board in baseload electricity generation for a number of different reasons. Not only do more middle class people want to use more electricity, but they're also probably looking at the same technology, next generation technologies as the US big tech companies, and they want to build out the data centers too.
yeah. Oh, AI. I forgot about that part of the story. Yeah, you're right. Yeah, China and India, they're less concerned with green power than they are with just power. Just give us the electricity we need one way or another. So they're setting up a lot of different kinds of power plants. But in that mix is a lot of nuclear compared to the amount of uranium that's available from today's miners. Um, but where were we? The AI story. Yeah. So it turns out that artificial intelligence is power hog. And if you're going to set up big data centers that can run the AIs that everybody's developing, you need massive numbers of NVIDIA chips running, which use up tremendous amounts of electricity. And that's over and above what we were going to need for electric cars and all the, the wiring that we were going to have to do for the chargers and stuff like that. So AI is a wild card in the electricity market because it's brand new. Nobody was talking about this 2 years ago. It wasn't in anybody's estimates. And now it's potentially one of the biggest demanders of electricity going forward. And it's just starting. There was one estimate that, okay, let me make sure I get this right. But an analyst came up with an estimate that said that just 1 year's worth of NVIDIA chips, once they're all running, will use as much electricity as Ireland. And that's 1 year. And the number of chips being produced 10 years from now will dwarf what NVIDIA produces now,
Well,
if all goes as planned.
also those next generation data centers and Bitcoin mining operations, they go through the hardware. The stuff gets burned out after a couple of years, so they have to keep replacing it. The capex cycles or replacement cycles are a
Hmm.
lot faster. They're only a couple of years where they have to upgrade. The other major issue with artificial intelligence, our listeners out there, I'm sure many of them have Chat GPT on their phone for search. If you use Chat GPT for a search, it's using, and Zero Hedge had some Wall Street bank analysts show the charts and the numbers. I think it was from different energy agencies and also Wall Street banks that were doing this. you're spending per search. So if you search on ChatGPT versus search on like a Google search or another normal internet browser, the amount of electricity usage, it's over 10 times the amount of electricity usage per search compared to the old search of a Google search or Mozilla Firefox or any of the regular web browsers.
I didn't see that, but it doesn't surprise me, all things considered. That's just how things are going now. We're basically starting a bunch of things that we have absolutely no idea how we're going to finish them. In other words, where the copper and the silver and the uranium is going to come from to meet the demands of the world we're creating 10 years hence. That's just unknowable right now. But unless they come up with some way of turning seawater into basic metals or something like that, we're going to need to mine a lot more than we're mining today. And we're going to need higher and higher prices in order to make that possible. So it's kind of shocking what we're setting up right now because it really looks like it ends with the mother of all commodity price moves, right? This is the bull market
It
that
also looks
commodity investors have been living for.
not just that with the demand side growing for commodities, it also looks like severe supply side problems and in higher prices in supply chains and input costs because the investments onto the supply side for new copper supply, new liquefied natural gas projects that are cheap with higher interest rates. I mean, they're not these projects very expensive to build even a medium-sized copper mine. It's over $1 billion. And with the interest rates where they are, it's very, very expensive to go and raise the capital to go build even one or two copper mines at a couple $1 billion each with interest rates where they are. So I think the interest rates are also killing not only demand, what the central banker textbooks say, I think they're going to be restricting or killing supply too.
Yeah, it really looks like prices have to go way up. But of course, as you said, rising commodity prices are inflationary. So that raises the prices of everything else. So it's not like um, copper and uranium and gold and silver are going to be going up in a vacuum. They're going to be going up. And then to the extent that they're an input in the energy system or whatever else they go into, then that makes all those other prices go up too. So this is an inflationary time. Oh, and while all this is going on, we're reshoring our manufacturing base. In other words, we have to build a bunch of new factories in the US or at least in Mexico to replace the capacity that we're moving out of China. And that's going to be really inflationary too, because we need all the components for those factories, and we need all the labor to staff those factories. So it looks like there's even if we were financially healthy, we would still have double-digit inflation for the next decade just because of all the transitions that we're setting up without that much regard to how much it's going to cost to get all the stuff that's going to be necessary. So it could be that there is a short thesis out there in the not too distant future for when these realities hit. In other words, if we just flat out do not have the energy to run 5 year hence data centers for AI, then that means those data centers can't be built, or at least can't be run efficiently and economically. And that's bad for the chip makers, right? So it could be that there's a point at which, right before this stuff hits, you want to be shorting NVIDIA and its peers. And it doesn't feel like today's that day, but it could be that that's a component of a big short kind of thesis out there that somebody will get right in terms of the timing, and they'll make the first individual hedge fund $1 trillion killing or something like that. So I think that's out there waiting to happen.
Well,
And
Mark Zuckerberg did an interview about this, and he basically said that they're going to have to get politicians with all the regulatory hurdles and the red tape. They're going to have to negotiate to get the nuclear power plants and the other power plants built either close to the data centers or build the data centers around existing ones or build new nuclear power plants. Because the Washington Post put out a story about interviewing an expert about like all the data centers that are here and all the ones that are planned under construction. And one of the experts quoted in the article, I think it was back in February, it was talking about how there's an electricity shortage based on all the data centers now and the ones in the future. The experts said that we need two new nuclear power plants built here in Northern Virginia to handle all the data centers that are going to be under construction, either already or about to start construction that are planned.
Yeah, and it's not easy to build two new nuclear power plants anywhere in the US. It's just a really hard thing to get through the regulators and stuff. So yeah, if big tech decides to start lobbying for that and they buy enough congressmen, they can do it. But I think it would be a big buy, even by big tech standards. They'd have to pay some serious money to a lot of congressmen to get that through the regulatory process in any kind of a reasonable time. And then it still takes a while. Even once you get the go ahead, it takes a while to set up a nuclear power plant. So it could be that there's 3 years from now, let's say, there's this crunch when the data centers are halfway to being built, and it dawns on people that the nuclear plant that's going to run the data centers is still 5 years out. And then what happens? And I think, see, in the chip market, it's always boom and bust. So this is nothing unusual um, in concept for the microchip market, but it's just way bigger. There probably has never
Well,
been a boom and a bust like this before.
yeah, I agree. There's also all the central planning with Congress passing the CHIPS Act. Have you seen how many micro semiconductor fab foundries, fabs or foundries are under construction globally? I think it's over 70.
Yeah. So the question will be, are we going to have a boom or a bust? When in other words, if they normally what they do is they have a boom and then they make too many microchip plants, their capacity goes up beyond current demand. And then you have a glut of chips and prices plunge and companies go out of business and stocks fall and things like that. So is that going to happen again? Or I'm not sure. I think we have
But
to kind of think this through because, like you said, there's an awful lot of chip capacity going online right now, and will there be too many chips for the available energy to run the chips? Will that be the glut that causes the bust in the microchip industry going forward? Possible. There's a lot of moving parts here and a lot of things. It's like cooking a 8-course dinner, right? Where everything has to be finished at the same time. Very tricky. And we're doing that on a global scale with tens of trillions of dollars right now.
so I think semiconductors, there could be a huge boom with all the foundries that come online, and then a bust outwards, like you said, over the next 5 to 7 years, because these are very large foundries, and they're going to take years to finish under construction and bring up online. And the nano chips, I think the chips are like, man, I can't remember all the Moore's law technical stuff, but the chips just keep getting smaller and smaller that they can put in the transistors into their the rest of people's bills. So that might be good for consumers, right? A cheaper laptop a few years from now if the chip prices do fall. But I mean, like for food, for gasoline, electricity, a lot of the everyday necessities, rent, mortgage payments. I mean, do you see any of these things falling, actual deflation, where the money supply falls and then prices subsequently fall for a long period of time? Do you see any of that?
Oh, that would be happening right now if the government wasn't running $1.5 to $2 trillion annual deficits. Basically, like you said, fiscal deficit or fiscal dominance, we're bailing everybody out so that high interest rates don't blow up huge parts of the consumer sector and the real estate sector. Because that's what normally happens. Interest rates go up to the point where nobody can buy a house, mortgage rates, which they've done. Hardly anybody can buy a house with a 7.5% mortgage right now. Normally, that would just collapse the housing market, and then commercial real estate would follow, and then the banks would follow, and you would have a stretch where prices either don't go up at all or they go down for a while. Life gets cheaper, but that's not any kind of a consolation because you're getting thrown out of your job. So life is much harder, even in a deflationary bust. But we'd be having that if we weren't using the federal government's budget to bail everybody out. So let them stop or let interest rates go up. For instance, one thing that could take us there is if inflation just doesn't slow down. If it stays, some of the core components of the inflation metrics now that we have are up at a 6 or 8% annual rate. So let them stay there and let the broader headline inflation numbers start to adopt that pace. And then interest rates have to go up even further. And at that point, it's not clear that the federal government can bail everybody out in a situation where mortgage rates are 9%, car loans are 15%. That could happen if interest or if inflation goes up from here instead of down. And then we would get that bust, and there wouldn't be much the government could do about it, short of just the mother of all bailouts. If the federal government decides to run $10 trillion deficits to keep the bust from turning into a 1930s style deflationary crash, who knows? We'll see. They might be able to affect the economy, but we're talking uncharted territory when that happens.
So you have all the talking heads on business TV and the politicians arguing about inflation because it's going to be a major issue for voters coming up in the November election with the economy and inflation. They're arguing about the CPI headlines and if the CPI number is going to continue to fall in a downtrend, although there's been a few surprise increases over the last few months, but in general, the trend has been down over the last year or so. But I think an important point that you brought up before we start recording is the accumulated inflation that we have over the last 3 to 5 years. And just using what the consumer price index and the other data, that number's up almost, 30% for a lot of the everyday items for a lot of people.
Yeah, life got really hard for people. And that's something that the government doesn't seem to recognize. They think if inflation goes down to 3%, well, then everything should be fine. But no, the food costs and rent and healthcare and tuition and everything, all the costs of living are up by a third in the past 3 or 4 years. And people still have to pay those bills, and their wages haven't gone up nearly enough to compensate. So their lives have gotten much harder. And just stabilizing inflation at 2 or 3% and having unemployment stay at 4% or 4.5% or whatever it is now. That sounds like a great number, but coming off of a 30% increase in the cost of living, it's not great at all. You got a whole gigantic section of the populace who really can't get by and who are really mad about it. So you get civil unrest, extremely unsettled politics, and then the politicians have to respond with extremely aggressive policies. That's where we are right now. No fix in sight.
So I've been trying to explain this to people about compounding because the average person doesn't understand like basic finance principles like compounding, whether you have a dividend stock and you reinvest your dividends. And at first you don't see a lot of big gains. There's also negative compounding. And that's what it has to do with the real inflation rate or the consumer price index. Because if you have even a 2% CPI or a 2% real inflation rate, and you have that 2% inflation for say 25, 30 years. And John, you've been writing books and warning about currency debasement, all this for a very, very long time. But if you have a real inflation rate of 2%, say 25, 30 years, I mean, by year 35, your prices, even at 2% inflation rate, your purchasing power has been cut in half.
Yeah, and that's what a lot of people are looking at. Well, they got close to that in just the last 3 years. So yeah, you cut somebody's purchasing power or their ability to pay their bills in half, and then you end up with some very angry people, some very angry homeless people. So you really don't want to do that. And the only reason that these guys did it is, well, they had two reasons. One is they really wanted to do a pandemic bailout, lockdown, et cetera, for reasons of their own. We can argue about why they did it, but they really wanted to do that. The second reason was their economists told them that it was okay, that you could raise the money supply by 30 or 40% and not really change anything. They were assured of that by the Paul Krugmans of the system.
Or Stephanie Kelton. There was like Stephanie Kelton for consulting work and think tank work here in DC. I mean, like there was a bunch of MMT people, especially Stephanie Kelton, getting a lot of consulting work and presentations at think tanks and, making a lot of extra dough here in the DC metro area. The MMT stuff has become very popular even before the pandemic, but during the pandemic when people are like, oh, we have to fight deflation.
Yeah, MMT is kind of analogous to a heroin addict deciding to switch to fentanyl or something like that, right? It's where you really step it up to the dangerous stuff. Two things about modern monetary theory. One is the basis of the theory is that, oh, we don't have to do this borrowing and taxing and everything. We'll just have the government create as much money as it needs and just run the economy that way. And now, of course, the fatal flaw in that concept is in the phrase as much money as it needs, right? Because if you turn the government loose, then its needs are going to multiply exponentially because there's no end to what the government could spend money on if you turned it loose and let it do it. Um, so that immediately leads to hyperinflation. There's no way around it. The other thing is we're already kind of doing that because what we do now is the government spends money and borrows money to cover it. The Federal Reserve, which is effectively another branch of the government, then creates a lot of new currency with which to buy the government bonds and take them off the market. So, in effect, we're financing the government with money creation by the Federal Reserve, which is basically MMT. So, maybe 1/3 of the government's budget is already financed the way Stephanie Kelton thinks it should be financed. And look where it's led us, you know? We had a year of almost double-digit inflation, and we can't get inflation down now. We've got everybody all freaked out because they can't pay their bills. And that's with just 1/3 MMT in government functioning. So let us go full MMT, 100% whole hog, just finance the government with newly created currency. And that's the end. That's when gold, we changed the name of gold to unobtainium. You just can't get it anymore because the currency is collapsing at an exponential rate and nobody wants to touch it.
Well, you're starting to have these other central banks, not the Federal Reserve Bank, which hasn't cut rates yet, although the market may throw a temper tantrum at some point if they don't start getting rate cuts with asset prices. But you're starting to hear rumors in the next month that the European Central Bank, the Bank of England, will start to cut rates. It looks like the playbook is they're going to let inflation run hot, more currency debasement, more debt monetization, and they're going to try to inflate the debt away in real terms with new currency.
That's a really good place to take us, Jason. Because one idea out there is that you can inflate debt away. That's something that people think you can do. But let's follow the logic of that. Let's say the US government decided it wanted to raise inflation and then make the existing debt less onerous because they're being paid back in deflated or devalued currency. What does that say to everybody else in the country? It says, go out and borrow as much money as possible and then pay it back in currency that's only worth 1/8 of what it was when you borrowed it, right?
Well, John, I would argue the rates for Main Street. So if you're a consumer, small business owner, you have penalty interest rates right now. If you're the US federal government, your interest rates are not that bad. Or a large corporation, large corporations have tons of cash, their borrowing costs are low. So it just creates more and more distortions. Main Street is getting killed with interest rates where they are now. Because
hmm? Yeah, but let's say the government, as part of its program of deflating the currency or depreciating the currency, pushes interest rates down. That's why it's printing so much money. It's lowering interest rates. And it's willing to accept the resulting inflation. But if inflation is higher than interest rates, see, it has to be an environment where inflation is higher than interest rates. You've got negative real interest rates for the debt to be inflated away. But then that just tells you and me to go out and borrow money, though, right? If we have negative interest rates, debt is really cheap. It's a really good thing to have. So
you're saying this if interest rates go lower, then and we could see it's evident that the government's going to inflate the debt away, and we could see that the real inflation rate's way higher than the consumer price index is claiming.
Yeah, because the government, by definition, it has to raise the inflation rate above interest rates on the debt, right, to make the debt less valuable. It has to, if it's going to shrink in real terms, then inflation has to be higher than interest rates. So they use quantitative easing to keep interest rates low and create a lot of currency and generate inflation. And that, in theory, makes the old debt less onerous. But it leads everybody else to borrow huge amounts of new money. And so the total amount of debt in the system goes up. And that's what happens whenever you try to inflate away the debt, unless you totally catch the market off guard. You know, if it's something they absolutely weren't expected and it happens for 3 or 4 years and then it ends, people don't figure it out quickly enough to go out and just gorge on debt. But as soon as it's obvious that it's government policy to do that, it becomes a self-negating feedback loop. And I think we're at that point now where people understand inflation well enough to know that if you get negative interest rates, you take them. You borrow at those negative interest rates as much as possible, and then you invest in things that are going up at the inflation rate. So borrow a huge amount of money, buy a bunch of gold, and you make it coming and going. Then, right? Your debt becomes less and less onerous while what you bought with the debt becomes more and more valuable. So you make a leveraged bet on on the system playing out that way, and it generally does. Whenever there's sustained inflation, debt goes up, not down.
Well, the other piece to this puzzle, and over the last like 40 or 50 years, foreigners have been larger purchasers of US Treasury debt. So, like all the countries running large trade surpluses, they recycled foreign exchange reserves into US Treasuries. That looks to have ended over the last year or two, especially with the Russia sanctions. That a lot of these governments, whether it's China or other emerging markets, especially outside the non G7 post Russia sanctions in 2022, even Japan has had to sell treasuries, but China just sold $400 billion worth of US treasuries. And we just have just steady dollar cost averaging from these non G7 central banks. They're not buying US treasuries. They're not funding these these budget deficits in DC that keep getting larger and larger and larger. They're dollar cost averaging gold tonnage pretty much each month.
Yeah, and I think they have two motivations for this. One is that I mean, they see what's happening financially, and they're making a choice to buy something, gold, that does not have a yield, and they're selling treasury bonds or refraining from buying treasury bonds that might yield 4 or 5%. So they're willing to forego that interest because they don't think it's going to last. They don't think that the real interest rate on treasury bonds is going to be an attractive proposition going forward. That's one motivation. The other is that the rest of the world is just sick of the U.S. government weaponizing the dollar and taking advantage of the fact that it has the world's reserve currency. And I think the thing that broke the camel's back was when the West froze a bunch of Russia's reserve assets and are now talking about using the interest from them to fund the Ukraine war and things like that. So now nobody's financial assets are safe out in the world if the country that owns those assets is going to do anything to cross the U.S. empire. So the BRICS countries, Brazil, Russia, China, India, and South Africa, are looking for ways to circumvent the dollar, and they're buying gold, but they're doing it not so much for economic reasons, but for geopolitical reasons. They're worried about what the U.S. is going to do to them next, and they want to be able to avoid that fate as well as possible. And one way they can do that is by having a lot of gold to back their currencies. Because in the financial world that they envision, gold is going to go up in value relative to the other currencies. And in the geopolitical world that they're worried about, gold will protect their currencies and their national wealth against depredations from an aggressive empire that they perceive to be out there. So they've got those two reasons for buying gold, and I think both are valid. And I think it's worked out really well for them so far. They got a nice embedded profit in the gold that they've bought in the past decade.
I heard an interesting statistic from another hedge fund manager. He was talking about how the U.S. national debt has roughly doubled in the last decade. Well, foreign governments, foreign central banks, they have not been net purchasers of even $1 trillion of that additional foreign debt that has doubled. So they have not added a significant amount of U.S. Treasuries. So they didn't even add $1 trillion more of U.S. Treasuries out of the 17 trillion in U.S. national debt that was increased. The other piece to this puzzle is that it seems there's very little demand, whether it's a pension fund, a private sector investor, or even foreign governments that would have recycled their trade surpluses into long-term treasuries. So it seems like all the interest in treasury demand on the supply-demand imbalance is at the short end of U.S. treasuries, while the U.S. wants to refinance a lot of the debt long-term, and then there's over $10 trillion of debt that has to be refinanced in the next couple of years.
Yeah, who's going to buy all that debt? That's a trick question. The Fed is going to buy most of that debt eventually. But yeah, we're doing things that are numerically unheard of. These numbers are just so big right now. And although one thing about this, that there will always, not always, but for a long time, there's going to be demand for dollars out there. First, because there's a lot of dollar-denominated debt, which requires dollars to pay the interest and principal back. And second, because despite it all, the U.S. financial markets are still the biggest and most liquid in the world. So if you want to get close to risk-free, very little is risk-free these days, but if you want to move your finances in the direction of risk-free, Treasury bonds are kind of part of that mix, just of necessity. There just isn't that much else out in the world that you can own that is more or less guaranteed to be paid back. So the dollar's not going to cease to exist as a trade and reserve currency. It's just that at the margins, people are deciding to go in other directions, and the overall demand for dollars as a reserve asset is shrinking in a lot of cases or flat in some other cases, but it's not growing in very many cases. In the case of very many central banks out there. So the trend is against the dollar, and it's in favor of these other currencies that are being used now by the BRICS countries for bilateral trade. And I think just this last year, the trends crossed between yen-denominated transactions and dollar-denominated transactions for China. Now, more than 50% of their transactions are taking place in I'm sorry, not yen, but yuan. So Chinese currency is now accounting for more than half of their transactions. And that's a huge deal, you know. It wasn't anything like that 10 years ago. The dollar was by far the most important trade currency, and it still is, but less so. Oh, go ahead.
I think a major point that I see mistakes everywhere online and in financial YouTube is people don't make a distinction between the US dollar and US treasuries, because I see a huge supply and demand issue developing in US treasuries where there's not a lot of demand, especially for long-term US treasuries, but in general, the size and amount of US treasuries that need to be sold by our government and refinanced at higher interest rates. But a lot of people in emerging markets and others, they still want the dollar because on a relative basis, the dollar is being inflated at a slower rate than their domestic currency. So I think there's a huge distinction between dollar demand, like you said, with dollar denominated debt, but also a lot of people in other countries, if your domestic currency, like the Argentinian peso or Turkish lira, is being inflated at a faster pace than the dollar, those people still want dollars.
Yeah, there are a lot of countries who would kill for 7% inflation. So yeah, that is absolutely the case. And all of these trends are they're longer term. They're not like this week this is going to happen or anything, but the trends are pointing in the direction of diminished demand for U.S. financial assets, but not necessarily this week or not necessarily before the next war happens. Or, you know, one of the funny things that happens, not funny, but strange funny, not haha funny, but is that even if the US is the one that causes trouble in the world, the dollar still goes up. Because even if we're the ones who start the war or do whatever other crazy thing we're doing out there, people still are afraid because of the turmoil that that's causing, and they migrate to dollar-denominated assets. So in a weird way, we benefit from the trouble that we cause in the world because we have the world's reserve currency. So it's a complicated picture. Hey, Jason, I just saw something here that we might want to talk about too. Do you remember with Salesforce.com, the company that they replaced Exxon with in the Dow Jones Industrial Average? I think it might have been,
I can't
but
remember off the top of my head, but the oil and energy companies, they have a large percentage of the profits in the S&P 500. I think like 15% of the total profits in the S&P
yeah. Oh, yeah.
500, and their market cap's only about 4 or 5%.
Yeah. But they kicked Exxon out of the Dow. And I think they replaced it with Salesforce.com. You know, if that turns out not to be true, just edit out this whole part here. But on CNBC right now, there's a headline: Stock futures slide as Salesforce tumbles on revenue miss, soft guidance. And Salesforce, you know, that's a staffing company. So when they view a weak year ahead, that means the economy is slowing down. So it could be that we're finally tipping into that recession that we were talking about before that should have happened already. And that might be one of the leading indicators of that process. So we might get the action that we've been talking about sooner rather than later if we start falling into recession.
In my opinion, a lot of the government economic data just becomes more and more fake each and every year, like GDP, money supply numbers, CPI versus the real inflation rate. I mean, shadow stats at one point, they had the real inflation rate getting up to just under 18% in annualized rate in 2022. I think the CPI said 9%. So it was off by enormously back then. So I think like the jobs reports numbers, what they removed, did you see they removed 800,000 jobs, which was most of the net jobs that were claimed to have been created in all of 2023. A couple of months ago, they just revised that down and removed 800,000 jobs from the year 2023.
Well, we could do a whole show on just the way the government lies in its statistics, right? And the labor market, well, I don't know, it's a tie, I think, between inflation and jobs because they lie so outrageously about both. But the jobs thing is hilarious because every um, every jobs number that comes out is excellent. The headline number is just exactly the right number of jobs, and the unemployment rate goes to exactly the right place. And then, the government comes out and says, "Wow, the economy is excellent. Look how many jobs we're creating." And then in subsequent months, they revise that big headline number down and down and down until it's at a level that's not really very impressive if it was the headline number back when. And then they do that over and over again. And as you mentioned, they just did the big one here, where they rounded up all the lies that they were telling for the previous year that they hadn't adjusted for yet, and they took it all in one big number. Took what did you say it was? 800,000 jobs or
Yeah,
eight
it was
million
two
jobs?
months ago. They said,
Yeah,
oh, by the way, in 2023, 800,000 of the jobs that we said were created were not actually created. We overestimated.
yeah, yeah. And so they knew this all along, and they knew what the revisions were going to be, and they knew that the revisions themselves were maybe not completely adequate to cover all the lies that they were telling. And so they just decided, hey, let's try to hide this in all the news that's going on out there. The Middle East and Ukraine and the election and everything, and then we'll just throw this little jobs number out there and hope nobody notices. And I bet most people didn't notice. It's the kind of thing that finance nerds pay attention to, but revisions to the jobs market aren't normally something that you see in headlines in an understandable way. So
Well, well, actually, John, if you say this publicly, like they won't allow you back on CNBC or Fox Business or Bloomberg if you start talking about the revisions and stuff like that. I mean, I've seen the revisions. The way the bank analyst, the PhD economist at like J.P. Morgan said is, "Oh, these revisions only occur as it builds up to an election." That was like the excuse that they get. But I mean, they've been going on for a long time, and it seems like they just get more and more egregious and worse every year.
yeah, well, it's because the needs of the government to fool us grow with time. The more mistakes they make, the more they screw up the financial system, the more necessary big lies are. And we're at the point now where, at least to you and me, the lies are so outrageous that it's amazing that they try to get away with it. But they do seem to get away with it because people just don't pay attention to this stuff.
Well, look at the stock market. As long as the stock market is in an uptrend, even if it's just Nvidia and one or two other companies dragging the index higher, I mean, most people don't want to talk about how the majority of companies, like a lot of the earnings reports, have not been good, especially a lot of the consumer discretionary income companies. It's like at best a bifurcated economy where like a lot of people on the high end, the luxury goods, those companies are doing well, and the non-luxury good companies, they're getting killed.
By the way, I just found a thing about Exxon and Salesforce. It was Salesforce that they replaced Exxon with in the Dow. I got a headline from 2022 that says Exxon has soared more than 150% to a record high since it was dropped from the Dow Jones Industrial as oil surges, while Salesforce has fallen by 30%. So yeah.
Well,
Anyhow, that's just
Exxon also borrowed. This was at the time we didn't know if it would work out, but in 2020 during the pandemic, they borrowed an enormous amount of debt at cheap rates, and they did a ton of investment and growth, and it's really paid off with oil production growth and discoveries.
yeah. Which the lesson there is don't kick commodities out of your big indexes. You should be adding commodity stocks to the Dow and to the S&P
But John, they
500.
hate
Yeah.
fossil fuels. They no cars. The goal for like Gavin Newsom and the Democrat National Committee, any politician that they pick for the nomination, they want to phase out fossil fuels, internal combustion engine cars.
Well, that's why they kicked Exxon out. They figured, well, we'll get rid of this dirty energy company and we'll put a nice technology company in there. Salesforce just everybody dresses well and they work in offices and stuff like that. So we'll have those be the representative of the American economy. So yeah, it's just funny. And
Except that if it's a tech company and they use artificial intelligence, like years from now, they're going to end up using even more electricity than a lot of the other companies.
that's right. They will be in effect way dirtier than Exxon is because they're using insane amounts of electricity. Yep. Unintended consequences everywhere you look.
Well, we've been going back and forth for over an hour. I really enjoyed my time today talking with you. Now, John, are you planning another book, or are you just focusing on writing articles and interviews on your Substack?
Yeah, my Substack is the whole thing for me now. It's at rubino.substack.com, and it basically covers the stuff we talked about with an emphasis on actionable ideas. In other words, how exactly do you prepare for all this crazy stuff? So far, so good.
You have a lot of updates on there. You have a lot of interviews behind the paywall and a lot of article updates too.
In a year and a half, I've ended up with going on 400 articles. So I think I'm overwhelming the audience with stuff, but there's just so much to write about now. This is an amazing world, and everywhere you look, fascinating stuff is happening.
Yeah, we're in a unprecedented territory because I think in financial history, a world reserve currency, we've never had a real hyperinflation, but it looks like all these other governments are all trying to do very similar tactics to what Japan has been doing all by itself for the last 20 or 30 years. And I just think that's going to cause higher prices in the supply chain. People are going to want workers are going to want higher wages. They're going to have potentially a wage price spiral. They raise interest rates. That doesn't just kill demand, it also kills supply. So I see more distortions. I see like best case scenario, John, based on the stupid policies from all these different governments and central banks. I think best case scenario, unfortunately, is more stagflation.
Yeah, well, stagflation would be the best case scenario if that's all the further we go. But I'm afraid this time around, stagflation is not fixable because in the 1970s, when we last had stagflation, we've basically fixed it by raising interest rates to 18 or 20%, depending on the rate that you're looking at. And that gave us a brutal 2-year recession in the early 1980s, but we came out of it in pretty good shape. Now there's no way to do that because we're so much more deeply indebted than we were back then that double-digit inflation rates would bankrupt half the world. And their bankruptcy would then cause the other half of the world to go bankrupt. So there's no way we could do that without completely blowing up the financial system. So we do not have a fix. And I think that's the headline of the next decade is that, oh, there's no way to fix this. And I think we'll find out pretty soon, especially if we get some stagflation in the near term, like you think is probable.
Yeah, we're just running out of road on the total amount of debt in society, whether it's government debt, corporate debt, small business debt, consumer debt. It's just too much debt at all levels of society. I think they bought another 15 years, give or take, since the 2008 financial crisis. The Fed did by going to zero interest rate policy and QE with the balance sheet expansion. But now here we are, over 300 trillion in global debt, and I just see a lot of problems everywhere. The U.S. stock market's rising, but there's problems everywhere else in the real economy.
Yeah, absolutely agree.